So here's a visual summary of the funds I'm invested in, guys. You can really see here that it's very well diversified across asset classes, countries, and industry sectors according to my strategy. So I've been asked over and over again about what are my recommended index funds and which stocks and shares I invest in. And I've actually avoided answering this question until now. Why? Because investing really is different for each individual, guys. We all have our own personal goals, preferences, risk tolerance levels, and we're all at different life stages and have different income levels, different family situations, etc. All of which will determine how each person actually invests. And you can check out my video on financial goals to find out more about this in a bit more detail. But with all that being said, I've done enough videos now, and we've been on this journey together long enough now for you to know and to understand all of these disclaimers and to not blindly replicate my investing portfolio that I'm about to share with you and copy it for yourselves, because your situation is going to be different to mine, and most importantly, I'm not a qualified financial advisor. So with that being stated up front, today I'm going to show you all of the funds and the stocks that I'm currently invested in and why. So I invest in funds and some stocks, but mainly funds. If you're wondering, the difference between the two is that a fund is essentially a collection of different stocks. So by investing in a single fund, you're investing in a range of different diversified, hopefully, stocks. Today we're going to look at all of the funds that I invest in, and I use the Fidelity platform to invest in all of my funds. Again, I made a video on how to choose an investing platform, so you can check that one out. So when it comes to funds, my strategy is to take medium to high risk because I'm young and I'm at a stage of life where I'm building my wealth for the future. So I want to take more risk, and when you take more risk, the flip side is that you can get higher potential returns. So when I get to 50, 60, I'll likely reduce the amount of risk involved, as it will be at a stage of my life where I want to consolidate and protect my wealth rather than build it, because hopefully I'd have already done it by then. But that's another video for another decade. Another part of my strategy is to achieve diversification, and I achieve diversification by exposing myself to a range of different industry sectors and different countries across the global economy. Home bias is something that a lot of us naturally fall into through no fault of our own, to be fair, and this is essentially where we tend to predominantly, or even at the extreme end, exclusively invest in UK companies and US, because we live here, we live on this side of the world. A lot of our consumption and our culture is dominated by UK and US companies, and we're exposed to them every day and buy from them every day because this is a part of the world that we live in. So the flip side is that we might end up ignoring all of the other huge countries across the rest of the world that are just as big and just as profitable as is US and UK companies. I also choose to reinvest all of my dividends to compound growth over the long term. And then lastly, I'm a long-term investor, guys. I'm not looking to sell anything anytime soon. In the next 10 years, at the very least, I buy and hold. So that's my strategy. Now let's look at the different funds that I'm invested in. So I've invested in 7 different funds over the last 3.5 years. Some have done better than others, as we're about to see, but across them all, I've made a 16% return over that 3.5 year period so far. And I'm all about showing proof. So here are the screenshots of the returns that I've made on each fund that I'm invested in over that period. So I'm going to reel off the names of these funds and returns to begin with quite fast, and then I'll cover what's actually in them in more detail afterwards. So don't worry about that, guys, that's coming. Right, so first up is the Schroders Greater China Fund. Schroders are an investment management company, and this is my second highest performing fund. It's earned me a 31% return since 2019, guys, so that's very good. Second is the Jupiter Distribution Fund. Jupiter are a fund management company, and this fund has earned me a very humble 2% return since 2017. Third is the Pictet Digital Fund. Pictet are a wealth and asset management company, and this is my highest performing fund. It's earned me a 42% return since 2017, guys. Fourth is the Fidelity Emerging Europe, Middle East and Africa Fund. This fund has produced a loss of -3% since 2019, guys, a loss. Fifth is the PICTEC Asian Equities Fund, excluding Japan. So everywhere in Asia, excluding Japan. This fund is earning a 25% return since 2019. Absolute win, guys. Sixth is the Fidelity India Focus Fund, which has earned me a 6% return since 2019. And then lastly is the M&G. M&G are a savings and investment company, managed growth fund, and this has earned me a 2% return since 2017. So now let's look at what's actually in these funds and what they're made up of. So the Schroders Greater China Fund is made up of 99% stocks and 1% cash. So it's basically a stocks fund, guys. It's a stocks fund. And as I mentioned, this fund has given me a 31% return over the past year, which is excellent. Now, geographically, these stocks that are inside of the fund are for companies primarily located in Asia, Asian stocks. And 3/4 of these stocks are from emerging Asian countries, okay? And then the remainder are from developed Asian countries. So in summary, this fund is made up of stocks in companies that are predominantly based in Asia's emerging companies, 3/4, and this is very much an emerging markets fund. And just in case you're interested, the emerging countries in Asia are defined as China, India, Indonesia, Malaysia, Korea, Pakistan, the Philippines, Taiwan, and Thailand. Now, these fund stocks are spread across the following industry sectors. 44% are cyclical stocks, which are defined as industries significantly impacted by economic shifts. So these tend to shrink during economic downturns and do well during economic upturns. For example, financial services, the property sector, the construction sector, or discretionary goods such as high-end handbags or luxury Ferrari cars, those types of sectors, guys. Then 49% of the stocks are sensitive stocks, which are industries that ebb and flow with the overall economy, but not as much as cyclical stocks. So these include sectors such as energy and technology. And then 7% of the stocks are defensive stocks, which protect you during economic downturns. They're defined as being immune to economic cycles for the most part. So these types of companies provide products and services that people need in both good and bad times, like healthcare and utilities, stuff like that, guys. Next up is the Jupiter Distribution Fund, and this is made up of 64% bonds and 23% stocks. So it's less risky than the fund that we just looked at that's made completely up of stocks. Government bonds are basically government debt and are generally less risky than stocks, guys. They're a good idea to have in some of your portfolio to de-risk it and make it a bit more safer and not too volatile, because bonds are less risky. They generally provide lower returns, and you can see this in the fund's return, which has been a huge 2% over the past 3 years, okay? Now, this is low even for a bond return, guys. So join me next week where I'm gonna be reviewing my portfolio. I'll do it with you together, and we'll look at what I'm going to do with some of the funds in my portfolio, such as this one. So will I sell it? Will I hold it going forwards? Join me next week to find out more about that. Now, geographically, these bonds and stocks are for companies located 80% in the UK, so it's UK focused, and 12% in the USA. So in summary, this is a fund made up of roughly 2/3 bonds and 1/4 stocks, mostly in the UK, and the remainder in the USA. This is a developed markets funds because UK and USA are developed countries. The stocks in the fund, the stocks, which is 1/4 of the fund, are spread pretty much equally across the following industry sector categories: cyclical stocks, sensitive stocks, and defensive stocks, equally across those three. Next is the PICTEC Digital Fund. This is made up of 98% stocks and 2% cash, so it's a stocks fund. This fund has given me a 42% return over the past 3 years. It's the highest of all my funds. It's an absolute star performer. Now, geographically, these stocks are for companies located 52% in the USA and the remainder non-USA. So in summary, this is a fund made up of tech stocks in companies that are half in the US and half non-US. This is very much a developed markets fund, guys. Now, this fund stocks are spread across the following industry sectors. 23% are cyclical stocks, 77% are sensitive stocks, and we just saw in the definitions that sensitive stocks includes tech. So, and this fund is mostly tech, so that makes sense. And that's how it's split, guys. My next fund is the Fidelity Emerging Europe Middle East fund that is made up of 93% stocks and 3% cash. So again, this is a stocks fund. This fund is running at a 3% loss for the past year. Now, geographically, these stocks are for companies located 50% in Africa, 33% in Europe's emerging countries, the emerging countries in Europe, 10% in the Eurozone, which are the developed countries in Europe. These include Austria, Belgium, Cyprus, Estonia, Finland, France, Germany, Ireland, Italy, Latvia, Lithuania, Luxembourg, Malta, Netherlands, Portugal, Slovakia, Slovenia, and Spain. I remembered all of that, guys. And then the emerging countries of Europe are basically every country except for those. So in summary, this fund is made up of stocks in companies, half of which are in Africa, and most of the remainder are across Europe. This is an emerging markets fund, guys. Now, these funds' stocks are spread across the following industry sectors. 62% are cyclical stocks, 32% are sensitive stocks, and 6% are defensive stocks. Moving on, we got the Pictet Asian Equities Fund, excluding Japan. This is made up of 99% stocks and 1% bonds, so it's a stock fund. This fund has given me a 25% return over the last year alone, which is excellent, as I said, guys. Geographically, these stocks are for companies located 57% in Asia's emerging countries and then 42% in Asia's developed countries. So, in summary, this fund is made up of stocks in companies that are based in Asia, roughly half and half split between the developed and emerging countries in Asia. Now, this fund's stocks are spread across the following industry sector categories. Half, 50%, are cyclical stocks, and then 44% are sensitive stocks, and then 7% are defensive stocks. Next, we have the Fidelity India Focus Fund, which is made up of 97% stocks and 3% cash, so it's a stock fund. This fund has given me a 6% return over the past year. Geographically, these stocks are for companies primarily located in Asia's emerging countries, guys. So this is an emerging markets fund. So in summary, this is a fund made up of stocks in countries that are predominantly based in Asia's emerging countries. This fund's stocks are spread across the following industry sector categories. 44% are cyclical stocks, 37% are sensitive stocks, and then 19% are defensive stocks. And then we have the M&G Managed Growth Fund, which is made up of 78% stocks, 6% bonds, and 6% cash. This fund has given me a 2% return over the past 3 years. Geographically, these stocks are for companies primarily located 1/3 in the USA, and then the rest is split over Japan, Europe, Asia, Australasia, Canada, Latin America, and Africa. So it's very diversified, guys. So in summary, this is a fund made up of 3/4 stocks in companies that are predominantly based across all the continents, and then the rest bonds. This fund's stocks are spread across the following industry sector categories. 36% are cyclical stocks, 41% are sensitive stocks, and then 23% are defensive stocks. So here's a visual summary of the funds I'm invested in, guys. Take a screenshot if you want, I don't mind. But what I really love about this screenshot is that you can really see here that it's very well diversified across asset classes, countries, and industry sectors according to my strategy. So when someone asks me, what are my recommended index funds or open-ended funds or mutual funds? My answer is, decide your strategy for yourself, but just make sure that they're well diversified. That's the name of the game, guys. And this is one of the primary benefits that funds give to you guys when you research and choose them well. I am a huge sponsor and advocate of funds. They're underrated, guys, and I highly recommend looking into them. For information on how to do that, please have a watch of my videos on what is an index fund and how to choose an index fund. Links are in the description below. I hope you found that useful, guys. Join me next week where I'll show you how I review my portfolio. We're going to come back to this portfolio and we're going to review it together, and you're going to see what decisions I make and what I keep, what I sell, and what I buy. If you found this video helpful, guys, don't forget to subscribe, share, comment. You guys have a good week, and I'll see you next Monday.